Assalamualaikum and salam sejahtera. This is topic 7, financial statements analysis. So we're going to cover the objective of financial statements, the types of analysis, the preparation and interpretation, and also the limitation of ratio analysis. At the end of this topic, you should be able to calculate the ratios and also to interpret the ratios for decision making purpose. Right, so let's look at the objective of financial statement. Right, so from Malaysian Accounting Standard Board, okay, in Malaysian Private Entities Reporting Standard, paragraph 2, stated that the objective of financial statement is to provide the information about the financial position, about the financial performance, and also about the cash flow of an entity that is useful to those users in making economic decision. So, to provide information for these financial position, performance, and cash flow is by preparing the financial statements, which are statement of profit or loss, statement of financial position, and also statement of cash flow. However, by referring only to the financial statements, by looking at all the numbers and figures, it might not be enough for us to assess the healthiness of our business. So we need to extend the work further by carrying out financial statement analysis. Okay, so the financial statement analysis will help us to make a better decision. All right, to make a better decision. Okay. What is a financial statement analysis? Okay, a financial statement analysis is simply the process of analyzing the financial statements, which are the statement of financial position, the statement of profit or loss. Okay, for decision making purposes, we are going to connect the numbers that we have in those statements. All right, instead of looking only at the numbers, all right, looking only at the trend, maybe increasing or decreasing in the numbers, we are going to connect them, all right, and then come up with a better information, all right, for a better decision making, all right. So the reason why we need to perform the financial statement analysis, number one, is to identify the strength and the weaknesses. Okay, after we create a relationship between the numbers, we can see something from there. Okay, and then we can see which area is the strength, and then which part, okay, is the weakness of the business. Okay, all right. So it is important that we identify the weakness, okay, because we need to plan, or we need to take any corrective action. Okay, we need to do something about that. Okay, we did not simply leave it as it is. Okay, because we need to improve our business financial performance and financial position in the future. Okay, so what are the common techniques used in the financial statement analysis? There are a few techniques, and one of it is ratio analysis. So for ACC 106, we're going to focus only on ratio analysis. So what is a ratio analysis? So the ratio analysis is the process of determining and interpreting numerical relationship based on the financial statements. So in the financial statement, you have numbers, right? Numbers for revenue, numbers for expenses, numbers for asset, liabilities, and also the equity. Okay, but if we leave it as it is, it might not be very useful. So to make it more useful, it is useful, but to make it more useful, okay, we are going to create a relationship. Okay, we are going to see we are going to analyze the relationship between these numbers. All right, okay, so we are going to calculate. All right, this is a technique of interpretation of the financial statement, okay, with the help of accounting ratio. All right. Okay, so what are the types of ratio analysis? Okay, so we're going to focus on 3 types of ratio analysis, which are liquidity ratio, efficiency ratio, and profitability ratio. And we're going to further break down into, for liquidity ratio, into current ratio and asset test or quick ratio. For efficiency ratio, we're going to focus on inventory turnover ratio and average collection period. While for profitability ratio, we're going to focus on gross profit margin and net profit margin. However, if you read further on this topic, ratio analysis, you might find that there are many ratios that we can use to analyze the financial statement. It does not limited to these ratios only. Okay, there are many other types of ratios, even for efficiency ratios, other than looking at the inventory, other than looking at the account receivable. You may also calculate the ratio for total asset, all right, for tangible asset, all right. Okay, so next we are going to look at each of these, starting from liquidity ratio. So what is the liquidity ratio? This ratio measures the ability of a business to meet its current obligation when they become due. Okay, simply looking at the financial statements, okay, we might not be able to, from the statements, you may see that you have asset, you have liabilities, but do we able to pay our liabilities when they become due? All right. So to know that, okay, we need to perform an analysis, okay, a ratio analysis, okay, called liquidity ratio. So two ratios here. The first one is current ratio. The other one is called acceptance ratio or quick ratio. So here we are going to see a relationship between the current asset and also the current liabilities. And the formula that we are going to use is current asset divided by current liabilities. Okay, so this is to analyze the ability of the business to pay its current liability when they become due using our current asset. Okay, so we are building a relationship, okay, between the current asset and current liabilities. Okay, so the ideal current ratio is 2 to 1, meaning that for every 1 ringgit of current liabilities, you have 2 ringgit of current asset to cover that 1 ringgit current liabilities. Okay, but you have to bear in mind that in current asset, we have least liquid asset, okay, to a very liquid asset. Okay, all right. So for least liquid asset, for example, the closing inventory. Okay, so for the inventory, it takes time for the business to convert inventory into cash. Okay, if you sold goods on credit, okay, if you sold goods on credit, you turn inventory into account receivable. Okay, and then for the account receivable, you have certain credit terms, for example, 30 days, 60 days, 90 days, even up to 120 days, meaning that, okay, it could take up to 120 days or whenever the customer feels like paying you the money, okay, paying you the debt. All right, so that is how long it takes for you to collect your money. All right, whereas you need to pay your current liability. So in order for us to analyze the ability of the business, whether or not we are able to pay the current liability, is by calculating the current ratio. But we have to bear in mind that in the current asset, we do have least liquid asset. Okay, meaning that there are assets that takes time to convert into cash. Okay, right. So because of that, okay, we are going to calculate another ratio called acid test or quick ratio. So acid test or quick ratio, we are going to remove certain elements in the current asset, which are inventories and prepayments. As I explained before, inventories take time to convert into cash. Whereas for the prepayments, there is a possibility that we might not recover the money, okay, from our prepaid expense. Okay, so that's why that those two, inventories and prepayments, are to be removed from the formula. So for acid test ratio, okay, the formula is current asset minus inventories minus prepayments, if any, divided by current liabilities. Okay, so this is to analyze the ability of the business to pay its current liabilities when they become due without the need to sell the inventory of the business. Okay, all right. So here we are going to we are building a relationship between the liquid asset and the current liabilities. Okay, we establish a relationship between liquid asset and current liabilities. Okay, so a high asset turns ratio is an indication that the firm is liquid and has ability to meet its current liability in time. Okay, while a low quick ratio represents that the business has a poor liquidity position. Okay, all right. So let's look at the next type of ratio analysis. Okay, which is profitability ratio. So profitability ratio, these are the ratios measure the performance of a business during an accounting period. So there are two ratios that we are going to use here. So the first one is gross profit margin and the other one is net profit margin. The formula for gross profit margin is gross profit divided by sales times 100, because we're going to present in percentage. Okay, right. So this is to analyze the business level of profitability before considering other income and also operating expenses. Okay, so if we look at the statement of profit or loss, we might see that okay, we have gross profit. Okay, but what is the level of profitability? Okay, before we consider other income and operating expenses. Okay, other interpretation that we can make from gross profit margin is the ability of the business in managing sales and cost of sales. All right, and it is often shown as a percentage of net sales. Okay, so a higher margin is more favorable than a lower margin, because you have to remember that gross profit margin is before you deduct the operating expenses. So if possible, we need to have a higher gross profit margin, okay, to make sure that we can cover other operating expenses. Okay, all right. So next is net profit margin. Okay, so net profit margin is equal to net profit divided by sales times 100. Okay, so this is to analyze the business level of profitability after we add other income and also after we deduct the operating expenses. Okay, all right. So for every 1 ringgit of sales that we made, okay, we want to know, do we have anything left, okay, for the owner. All right, it shows the ability, okay, other than analyzing the business level of profitability, it also shows the ability of the business in managing the sales, the cost of sales, other income, and all operating expenses. Okay, whether or not at the end of the day, okay, we have any profit left. Okay, it also shows the amount available to the owner of the business for the year. All right, typically expressed as a percentage of net sales, and similar to gross profit margin, a higher margin is more favorable than a lower margin. Okay, because if you have a higher margin, meaning that you have more at the end of the day as the owner. All right, okay, next. Okay, so next type of ratio is efficiency ratio. So this ratio measures the efficiency of a business in managing its asset to generate revenue. All right. So for the efficiency ratio, we basically look at the current the item of asset. Okay, which are the inventory, and also the next one is the account receivable. Okay, so let's look at this one first. Okay, so this is to calculate the inventory turnover ratio, and the formula is cost of goods sold divided by average inventory. Average inventory meaning that opening inventory plus closing inventory divided by 2. Okay, where we find the average inventory for the year. What if you don't have the amount for opening inventory? Okay, then you take only the closing inventory. That would be your denominator. All right. Okay, so we calculate inventory turnover ratio to analyze how many times a business replaces its inventory during a given period. We want to know how fast the business change the inventory. Okay, because the faster you replace the inventory, meaning that you are making sales. Okay, if it takes time for you to replace the inventory, okay, it means that you are not making sales. Okay, it takes time. Okay, or your your sales is not as fast as the other business. So you have to think of something. All right. So the business is in a good position if it has a higher inventory turnover ratio. It means that the business can sell its goods quickly. The business is in a poor position if it has a lower inventory turnover ratio, because it means that the business is not selling goods fast enough, which resulting in accumulated stock and no money flowing into the business because you are not able to sell the inventory. All right. Okay. Next, the average collection period. Okay, so the average collection period is where you analyze the length of time undertaken by a business to collect money from the debtors or account receivables. Okay, it measure on average how long it takes for you, okay, to collect the money from your receivables, okay, from your credit customer, from your debtors. So the formula is, okay, average collection period equal to account receivable divided by credit sales. If you have no information on credit sales, then we are going to assume that all sales are credit sales. Okay, times with 365 days. Okay, so which one is better? A shorter period or a longer period? Okay, a shorter period is better because it means that the business can collect money efficiently from its debtor or accounts receivable and use the money for business operation. If the period is longer, it means that the business is in poor position, the business is not collecting money fast enough, and the business may not have enough cash resources to operate the business. So the business is not efficient in managing the account receivable. The business has to think of something. Okay, they have to maybe strengthen their collection policy. They have to strengthen their credit policy. They need to know who are the credit customer. Okay, they need to check the background of their customer first before they grant the credit. All right, to avoid this problem. Because if they takes a longer time to collect the money from the accounts receivable, they might face a cash problem in the future. All right. Okay. So that's all for the 3 types of ratio analysis, which are liquidity ratio, profitability ratio, and also the efficiency ratio. Okay. All right. So from there, I hope that you understand how useful it is, okay, when you calculate, okay, or when you perform the ratio analysis, okay, instead of preparing the financial statements only. Okay, you have to extend the work, you have to calculate the ratio, all right, so that you can see, okay, you can measure, all right, or you can yes, you can measure the ability of the business, all right, to pay for the debts, all right, to manage their asset, and also to make profit.